Question 1. Policy provisions and endorsements. Which of the following is a common endorsement added to a standard homeowners insurance policy in California to provide additional coverage for high-value items? A. Replacement cost endorsement. B. Scheduled personal property endorsement. C. Earthquake endorsement. D. Inflation guard endorsement. Answer: B. Scheduled personal property endorsement. Explanation: a scheduled personal property endorsement is often added to a standard homeowners insurance policy to provide additional coverage for high-value items like jewelry, art, and collectibles. This endorsement ensures that these items are covered for their appraised value, which may exceed the policy limits for unscheduled personal property. Replacement cost endorsement provides for replacement cost coverage instead of actual cash value. Earthquake endorsement adds coverage for damage due to earthquakes, which is excluded under standard policies. Inflation guard endorsement adjusts the coverage limits to account for inflation over time. In California, where high-value personal property is common, adding a scheduled personal property endorsement is crucial to ensure adequate coverage. Question 2. Scenario-based question. Liability and legal concepts. Mr. Davis owns a restaurant in California. One of his customers slipped on a wet floor and suffers a severe injury. Mr. Davis has a commercial general liability (CGL) insurance policy. Which of the following best describes what Mr. Davis should do following the incident to ensure proper handling of the claim? A. Immediately repair the wet floor and resume business operations. B. Offer the injured customer a cash settlement to avoid a lawsuit. C. Report the incident to his insurance company as soon as possible. D. Wait until the customer decides to file a lawsuit before taking any action. Answer: C. Report the incident to his insurance company as soon as possible. Explanation: Mr. Davis should report the incident to his insurance company as soon as possible. Prompt reporting is essential in liability claims to ensure the insurance company can conduct a timely investigation and provide appropriate defense or settlement if necessary. Repairing the wet floor and resuming business operations. While important for safety, it does not address the claim. Offering a cash settlement can be seen as admitting liability and may complicate the claim process. Waiting until the customer decides to file a lawsuit delays the claim process and may result in a breach of policy conditions. California law and insurance policies require prompt notification of incidents to ensure proper claims handling and legal compliance. Question 3. Insurance contract formation. In California, which element is not required for the formation of a valid insurance contract? A. Offer and acceptance. B. Consideration. C. Insurable interest. D. Notarization. Answer: D. Notarization. Explanation: for the formation of a valid insurance contract in California, notarization is not required. The essential elements include offer and acceptance. The insurer makes an offer through the policy and the insured accepts it. Consideration: the premium paid by the insured and the promise of coverage by the insurer. Insurable interest: the insured must have a financial interest in the property or life being insured. Notarization is not a legal requirement for insurance contracts in California, although it may be required for other types of legal documents. Question 4. Coverage and exclusions. In California, which of the following perils is typically excluded from a standard homeowners insurance policy? A. Fire. B. Theft. C. Earthquake. D. Windstorm. Answer: C. Earthquake. Explanation: standard homeowners insurance policies in California typically exclude earthquake damage. Homeowners in California need to purchase separate earthquake insurance to cover losses from earthquakes. Fire, covered under standard policies as it is a common peril. Theft, covered to protect against loss from burglary and theft. Windstorm, covered including damage from hurricanes and tornadoes. Due to California's high seismic activity, earthquake insurance is offered as an additional policy or endorsement to standard homeowners insurance. Question 5. Scenario-based question. Claim settlement methods. Mrs. Martinez's house in California was partially damaged by a wildfire. Her homeowner's insurance policy includes a replacement cost endorsement. The adjuster estimates the repair costs at $50,000, but Mrs. Martinez has found a contractor who can do it for $40,000. What will her insurance company likely do under the terms of her policy? A. Pay Mrs. Martinez $50,000 to cover the adjuster's estimate. B. Pay Mrs. Martinez $40,000 to cover the contractor's quote. C. Pay Mrs. Martinez $45,000 as a compromise between the two estimates. D. Refuse to pay until the repairs are completed and inspected. Answer: B. Pay Mrs. Martinez $40,000 to cover the contractor's quote. Explanation: under a replacement cost endorsement, the insurance company will typically pay the actual cost of repairs up to the policy limits. Since Mrs. Martinez has found a contractor who can do the work for $40,000, the insurer will likely pay this amount. Paying $50,000 would exceed the necessary cost for repairs. Paying $45,000 is not a standard practice unless specifically negotiated. Refusing to pay until repairs are completed is not consistent with typical replacement cost procedures, although some insurers may require proof of completed repairs before final payment. California insurance regulations ensure fair settlement based on actual repair costs. Question 6. Insurance underwriting. Which of the following factors is not typically considered during the underwriting process for a commercial property insurance policy in California? A. Location of the property. B. Business owner's personal credit score. C. Type of construction of the building. D. Past claims history of the property. Answer: B. Business owner's personal credit score. Explanation: while a business owner's personal credit score might be considered in some contexts, it is not typically a primary factor in underwriting commercial property insurance policies. Underwriting focuses more on the property and business operations. Location of the property affects risk exposure to natural disasters, crime, and other hazards. Type of construction of the building influences the risk of damage from perils like fire and earthquakes. Past claims history of the property indicates the likelihood of future claims. In California, commercial property insurance underwriting prioritizes factors directly related to the property's risk profile. Question 7. Types of property insurance policies. Which of the following types of property insurance policies is most appropriate for a small business owner in California who wants to insure both the building and its contents? A. Homeowner's policy. B. Business owner's policy BOP. C. Personal articles floater. D. Dwelling policy. Answer: B. Business owner's policy BOP. Explanation: a business owner's policy BOP is designed specifically for small to medium-sized businesses and provides comprehensive coverage including both the building and its contents. Homeowner's policy intended for residential properties, not businesses. Personal articles floater provides coverage for specific high-value personal items, not buildings. Dwelling policy primarily covers residential rental properties and does not include business contents coverage. In California, a BOP offers the right balance of property and liability coverage for small businesses, protecting against various risks they face. Question 8. Scenario-based question. Workers' compensation insurance. MS. Thompson runs a landscaping business in California. One of her employees, Alex, injures his back while lifting heavy equipment. What should MS. Thompson do to ensure compliance with California's workers' compensation laws? A. Pay for Alex's medical expenses out of pocket. B. File a workers' compensation claim with her insurance company. C. Ignore the injury since Alex did not follow proper lifting procedures. D. Ask Alex to use his personal health insurance for treatment. Answer: B. File a workers' compensation claim with her insurance company. Explanation: MS. Thompson should file a workers' compensation claim with her insurance company. California law requires employers to provide workers' compensation coverage for all employees, ensuring they receive medical care and compensation for work-related injuries. Paying out of pocket does not comply with legal requirements and exposes MS. Thompson to additional liabilities. Ignoring the injury violates California workers' compensation laws and can lead to penalties. Using personal health insurance is not appropriate for work-related injuries and shifts the burden improperly. California's workers' compensation system is designed to protect both employees and employers by providing a structured process for handling work-related injuries. Question 9. Policy structure and components. In California, which part of an insurance policy contains information about the insured, the property covered, and the policy limits? A. Insuring agreement. B. Exclusions. C. Declarations page. D. Conditions. Answer. C. Declarations page. Explanation. The declarations page of an insurance policy provides critical details about the insured, the property covered, and the policy limits. It is the first part of the policy that outlines the specifics of coverage. Insuring agreement describes the insurer's promise to pay for covered losses. Exclusions lists perils or situations not covered by the policy. Conditions outlines the duties and obligations of both the insurer and the insured. Question 10. Coverage determination. In California, which of the following is not typically covered under commercial general liability CGL policy? A. Bodily injury to customers. B. Property damage caused by the insured's product. C. Employee injuries. D. Personal and advertising injury. Answer. C. Employee injuries. Explanation. Employee injuries are typically covered under workers' compensation insurance, not a commercial general liability CGL policy. Bodily injury to customers, covered by CGL for incidents occurring on the business premises. Property damage caused by the insured's product, covered by CGL for damages resulting from the insured's products or operations. Personal and advertising injury, covered by CGL for issues such as defamation or copyright infringement in advertising. California, businesses must maintain separate workers' compensation insurance to comply with state laws and protect employees. Question 11. Scenario-based question. Consumer protection and fair practices. Mr. Green, an insurance producer in California, is approached by a client who wishes to purchase a high-value life insurance policy. The client appears unsure about certain aspects of the policy and its benefits. What is the most appropriate action Mr. Green should take to comply with California's consumer protection laws? A. Encourage the client to sign the policy quickly to lock in the rates. B. Fully explain the policy terms, benefits, and any exclusions to the client. C. Ask the client to consult with a lawyer before signing. D. Offer to waive the first premium to secure the client's business. Answer. B. Fully explain the policy terms, benefits, and any exclusions to the client. Explanation. Mr. Green should fully explain the policy terms, benefits, and any exclusions to the client to comply with California's consumer protection laws. Insurance producers are required to ensure that clients understand the coverage they are purchasing. Encouraging a quick signature can be seen as high-pressure sales tactics and is against ethical practices. Consulting with a lawyer, while helpful, it does not replace the producer's responsibility to explain the policy. Offering to waive the first premium could be considered unethical or even illegal, as it may influence the client's decision improperly. California law emphasizes transparency and fair practices to protect consumers in insurance transactions. Question 12. Insurance underwriting guidelines. Which of the following underwriting guidelines is most crucial for determining the premium of a commercial auto insurance policy in California? A. The color of the vehicles. B. The number of drivers. C. The type of fuel used by the vehicles. D. The brand of the vehicles. Answer. B. The number of drivers. Explanation. The number of drivers is a crucial factor in underwriting commercial auto insurance policies, as it directly impacts the risk exposure of the insurer. More drivers mean a higher probability of accidents influencing the premium. Color of the vehicles, irrelevant to risk assessment. Type of fuel used by the vehicles, not typically considered in standard underwriting for commercial auto insurance. Brand of the vehicles, while it might influence repair costs, it is not a primary factor in determining premiums. Question 13. Claims handling process in California. What is the primary purpose of the initial investigation phase in the insurance claims handling process? A. To determine the insured's premium payment history. B. To assess the validity and extent of the claim. C. To negotiate the settlement amount with the claimant. D. To review the insurance policy's exclusions. Answer: B. To assess the validity and extent of the claim. Explanation: the primary purpose of the initial investigation phase in the insurance claims handling process is to assess the validity and extent of the claim. This involves gathering all necessary information, such as police reports, witness statements, and damage assessments, to determine if the claim is covered and the appropriate amount to be paid. Premium payment history. Relevant for policy status but not the main focus during claim investigation, negotiating the settlement amount usually occurs later in the process after the claim has been validated. Reviewing policy exclusions is part of the investigation but not its primary purpose. In California, insurers are required to conduct thorough investigations to ensure claims are handled fairly and in accordance with the policy terms and state regulations. Question 14. Scenario-based question. Coverage and exclusions. MS. Liu owns a retail store in California. A nearby construction project causes vibrations that result in a crack in her store's wall. She files a claim with her commercial property insurance. Which exclusion is most likely to apply to her claim? A. Wear and tear. B. Earthquake. C. Vandalism. D. Construction defects. Answer: D. Construction defects. Explanation: the construction defects exclusion is most likely to apply to MS. Lee's claim. Most commercial property insurance policies exclude damage resulting from construction defects or activities by third parties. Wear and tear covers gradual deterioration, not sudden damage from external vibrations. Earthquake, specific to seismic activity, not related to construction vibrations. Vandalism, covers intentional damage caused by people, not construction-related issues. In California, commercial property insurance policies typically exclude coverage for damage resulting from construction activities unless specific coverage is added through endorsements. Question 15. State-specific insurance regulations. In California, which entity is responsible for overseeing the regulation and enforcement of insurance laws? A. Federal Insurance Office, FIO. B. National Association of Insurance Commissioners, NAIC. C. California Department of Insurance, CDI. D. Securities and Exchange Commission, SEC. Answer: C. California Department of Insurance, CDI. Explanation: the California Department of Insurance, CDI, is the state entity responsible for overseeing the regulation and enforcement of insurance laws in California. The CDI ensures that insurance companies and agents operate fairly and comply with state laws to protect consumers. Federal Insurance Office, FIO, provides oversight at the federal level but does not regulate state-specific insurance laws. National Association of Insurance Commissioners, NAIC, an organization that assists state insurance regulators but does not directly enforce laws. Securities and Exchange Commission, SEC, regulate securities and markets, not insurance. The CDI plays a critical role in maintaining the integrity of the insurance market in California, protecting consumers, and ensuring industry compliance with state laws. Question 16. Policy provisions and endorsements. Which of the following endorsements can be added to a homeowner's insurance policy in California to provide coverage for damage due to sewer backup? A. Water damage endorsement. B. Flood insurance endorsement. C. Sewer backup endorsement. D. Earthquake endorsement. Answer: C. Sewer backup endorsement. Explanation: a sewer backup endorsement specifically provides coverage for damage resulting from the backup of sewers or drains, which is typically excluded from standard homeowners insurance policies. Water damage endorsement covers water damage from sources like broken pipes but not sewer backup. Flood insurance endorsement covers flooding from external water sources, not internal sewer issues. Earthquake endorsement provides coverage for damage due to earthquakes, not water-related issues. In California, homeowners should consider adding a sewer backup endorsement if they are at risk of such incidents, as it ensures coverage for otherwise excluded perils. Question 17. Scenario-based question. Liability and legal concepts. MS. Hernandez owns a cafe in California. A customer slips on a wet floor and sustains injuries. The customer claims that the floor was not marked with a warning sign. MS. Hernandez's commercial general liability (CGL) policy includes premises liability coverage. What should MS Hernandez expect regarding the insurance company's handling of the claim? A. The insurance company will deny the claim because the floor was wet. B. The insurance company will likely cover the claim under premises liability coverage. C. The insurance company will cover the claim only if MS Hernandez pays a higher premium. D. The insurance company will require MS Hernandez to handle the claim personally. Answer B. The insurance company will likely cover the claim under premises liability coverage. Explanation: under premises liability coverage in a commercial general liability (CGL) policy, the insurance company will typically cover claims for injuries sustained on the insured's premises due to negligence, such as failing to mark a wet floor with a warning sign, denying the claim, unlikely unless there is a specific policy exclusion requiring higher premium. Premium adjustments are made during policy renewal, not claim handling. Handling the claim personally. The insurer handles claims as part of the policy agreement. California, businesses must maintain premises liability coverage to protect against such risks, ensuring they are covered for incidents involving customer injuries on their property. Question 18. Valuation of property. In California, which valuation method reimburses the policyholder for the cost to replace damaged property with new property of like kind and quality without deducting for depreciation? A. An actual cash value (SEV). B. Market value. C. The agreed value. D. Replacement cost. Answer: D. Replacement cost. Explanation: the replacement cost valuation method reimburses the policyholder for the cost to replace damaged property with new property of like kind and quality without deducting for depreciation. Actual cash value (SEV) reimburses the cost to replace damaged property minus depreciation. Market value reflects what the property could sell for in the market, not commonly used in insurance. Agreed value: a predetermined amount agreed upon by the insurer and insured, regardless of depreciation. In California, many homeowners and business owners prefer replacement cost coverage to ensure they can fully restore their property without facing a shortfall due to depreciation. Question 19. Insurance contracts. Which of the following is a fundamental principle of insurance contract law in California that requires the insured to have a legitimate interest in the preservation of the insured property? A. Indemnity. B. Insurable interest. C. Subrogation. D. Utmost good faith. Answer: B. Insurable interest. Explanation: insurable interest is a fundamental principle of insurance contract law that requires the insured to have a legitimate interest in the preservation of the insured property. This ensures that insurance policies are not used for speculative purposes. Indemnity ensures the insured is restored to the financial position they were in before the loss without making a profit. Subrogation allows the insurer to pursue recovery from a third party responsible for the loss. Utmost good faith requires both parties to act honestly and disclose all relevant information. In California, having an insurable interest is crucial to the validity of an insurance contract, ensuring that the insured stands to suffer a genuine loss if the property is damaged or destroyed. Question 20. Scenario-based question. Casualty insurance basics. Mr. Johnson owns a delivery service in California. One of his drivers is involved in an accident while making a delivery, resulting in significant property damage to a third party's vehicle. Which type of insurance should Mr. Johnson rely on to cover the damages to the third party's vehicle? A. Comprehensive coverage. B. Collision coverage. C. Liability coverage. D. Medical payments coverage. Answer: C. Liability coverage. Explanation: liability coverage is designed to cover damages to third parties' property and injuries resulting from an accident for which the insured is at fault. Comprehensive coverage covers non-collision related damages to the insured's vehicle such as theft or natural disasters. Collision coverage covers damages to the insured's vehicle from a collision. Medical payments coverage covers medical expenses for the insured and passengers, regardless of fault. In California, liability coverage is mandatory for vehicles and is crucial for business owners like Mr. Johnson to protect against financial losses due to accidents involving third parties. Question 21. Insurance policy analysis. Which section of an insurance policy in California outlines the circumstances under which coverage will not be provided? A. Declarations. B. Insuring agreement. C. Exclusions. D. Conditions. Answer: C. Exclusions. Explanation: the exclusions section of an insurance policy outlines the circumstances under which coverage will not be provided. It specifies the perils, conditions, and types of damage or loss that are not covered by the policy. Declarations: provides essential information about the policy, such as the insured's details, the property covered, and policy limits. Insuring agreement describes the insurer's promise to pay for covered losses. Conditions outlines the duties and obligations of both the insurer and the insured. Question 22. Underwriting process and principles. In California, which of the following factors is least likely to be considered during the underwriting process for a homeowner's insurance policy? A. The age of the home. B. The homeowner's occupation. C. The location of the home. D. The home's construction materials. Answer: B. The homeowner's occupation. Explanation: a homeowner's occupation is generally not a significant factor in underwriting a homeowner's insurance policy. Underwriting primarily focuses on the physical characteristics and location of the property as well as the homeowner's claims history. The age of the home, important for assessing risk related to outdated systems or materials. The location of the home, critical for evaluating risks such as crime rates, proximity to fire stations and natural disaster zones. The home's construction materials, relevant for determining how the home might withstand various perils. In California, underwriting emphasizes factors directly related to the property's risk profile rather than personal details about the homeowner that do not affect the property's risk. Question 23. Scenario-based question. Claim settlement methods. Mr. Rodriguez's home in California was damaged in a storm. His homeowner's insurance policy includes an actual cash value SEV provision. The roof repair is estimated at $20,000, but the roof is 10 years old and has depreciated by 50%. How much will Mr. Rodriguez's insurance company likely pay for the roof repair? A. $20,000. B. $10,000. C. $15,000. D. $5,000. Answer: B. $10,000. Explanation: under an actual cash value SEV provision, the insurance company pays the replacement cost of the damaged property minus depreciation. Since the roof repair is estimated at $20,000 and has depreciated by 50%, the payment would be $20,000. 50% of $20,000 equals $1,000. $20,000 would be the replacement cost without depreciation. $15,000. Incorrect calculation of depreciation. $5,000. Overestimates the depreciation amount. In California, homeowners should be aware of the difference between ACV and replacement cost coverage, as ACV accounts for depreciation and may result in low claim payments. Question 24. Insurance contracts. Representations and warranties. Which of the following best describes a warranty in the context of an insurance contract in California? A. A promise made by the insurer to cover specific risks. B. A statement of fact or condition that must be true for the policy to be valid. C. A provision that outlines the policy limits and deductibles. D. A guideline for filing a claim. Answer: B. A statement of fact or condition that must be true for the policy to be valid. Explanation: a warranty in the context of an insurance contract is a statement of fact or condition that must be true for the policy to be valid. If a warranty is breached, the insurer may void the policy or deny a claim. A promise made by the insurer describes the insuring agreement, not a warranty. A provision that outlines the policy limits and deductibles, part of the declarations or insuring agreement. A guideline for filing a claim, part of the policy conditions or endorsements. In California, warranties are critical elements of insurance contracts, ensuring that certain conditions are met and maintained for the coverage to remain in effect. Question 25. Loss settlement methods. In California, under replacement cost policy, what is typically required for a policyholder to receive full reimbursement for a covered loss? A. The policyholder must repair or replace the damaged property. B. The policyholder must provide an estimate of the property's current market value. C. The policyholder must submit a claim within 30 days of the loss. D. The policyholder must purchase additional coverage for the full value. Answer A. The policyholder must repair or replace the damaged property. Explanation. Under a replacement cost policy, the policyholder is typically required to repair or replace the damaged property to receive full reimbursement. This ensures that the insured property is restored to its pre-loss condition, providing an estimate of the current market value, relevant for actual cash value policies, not replacement cost, submitting a claim within 30 days. While timely claim submission is important, it is not specific to replacement cost reimbursement. Purchasing additional coverage, not required if replacement cost coverage is already in place. In California, replacement cost policies help policyholders rebuild or replace damaged property without factoring in depreciation, provided the property is repaired or replaced. Question 26. Scenario-based question. Underwriting considerations. Ms. Jackson is applying for homeowners insurance in California. Her home is located in an area prone to wildfires. What underwriting consideration is most likely to affect her policy terms and premium? A. The home's architectural style. B. The home's proximity to a fire hydrant. C. The color of the home's exterior. D. The number of bedrooms in the home. Answer. B. The home's proximity to a fire hydrant. Explanation. The home's proximity to a fire hydrant is a critical underwriting consideration in areas prone to wildfires, as it directly impacts the ability to fight fires and reduce damage. Architectural style, less relevant to fire risk. Color of the exterior, not a factor in underwriting for fire risk. Number of bedrooms, relevant for assessing the home's overall value but not specific to fire risk. In California, insurers assess various factors to determine the risk of wildfire damage and set premiums accordingly, including the home's location and accessibility to firefighting resources. Question 27. Casualty insurance. Coverage and exclusions. Which of the following is typically excluded from coverage under a standard commercial general liability (CGL) policy in California? A. Bodily injury to a customer on the business premises. B. Property damage caused by a product manufactured by the business. C. Injuries to employees while performing work-related tasks. D. Personal and advertising injury liability. Answer. C. Injuries to employees while performing work-related tasks. Explanation. Injuries to employees while performing work-related tasks are typically excluded from coverage under standard commercial general liability (CGL) policy. Such injuries are usually covered under workers' compensation insurance. Bodily injury to a customer, covered under CGL for premises liability. Property damage by a product, covered under CGL for product liability. Personal and advertising injury liability, included in standard CGL policies. In California, businesses must carry workers' compensation insurance to cover employee injuries, while CGL policies cover third-party bodily injury, property damage, and certain types of personal injury. Question 28. Policy provisions and endorsements. Which of the following endorsements can be added to a commercial property insurance policy in California to protect against losses due to business interruption? A. Extra expense endorsement. B. Business income endorsement. C. Ordinance or law endorsement. D. Equipment breakdown endorsement. Answer. B. Business income endorsement. Explanation. A business income endorsement provides coverage for lost income when a business is unable to operate due to a covered loss. This endorsement helps ensure that the business can continue to pay expenses and sustain itself during a period of interruption. Extra expense endorsement covers additional expenses incurred to continue operations after loss, but does not cover lost income. Ordinance or law endorsement covers increased costs due to changes in building codes or laws after loss. Equipment breakdown endorsement covers losses due to mechanical or electrical breakdown of equipment, but not lost income. In California, businesses often add business income endorsements to their commercial property insurance policies to protect against the financial impact of business interruptions. Question 29. Scenario-based question. Liability and legal concepts. Mr. Thompson operates a construction company in California. During a project, a subcontractor's negligence results in significant property damage to a neighboring property. Which type of liability coverage should Mr. Thompson's insurance policy have to cover the damages caused by the subcontractor? A. Professional liability. B. General liability. C. Completed operations liability. D. Contractual liability. Answer: B. General liability. Explanation: general liability insurance provides coverage for third-party property damage and bodily injury caused by the insured or their operations. This includes damage caused by subcontractors working under the direction of the insured. Professional liability covers errors and omissions in professional services, not property damage. Completed operations liability covers liability after a project is completed, not during the ongoing operations. Contractual liability covers liability assumed under a contract, but general liability is the primary coverage for third-party damages. In California, construction companies should have general liability insurance to cover property damage and bodily injury caused by their operations or subcontractors. Question 30. Insurance underwriting. Risk assessment and selection. In California, which factor is most likely to influence the underwriting decision and premium rate for a personal auto insurance policy? A. The color of the car. B. The type of fuel the car uses. C. The driving record of the insured. D. The number of doors on the car. Answer: C. The driving record of the insured. Explanation: the driving record of the insured is a critical factor in underwriting auto insurance policies as it directly reflects the risk of future claims. A history of traffic violations or accidents typically results in higher premiums. Color of the car, irrelevant to risk assessment. Type of fuel, not typically considered in standard underwriting. Number of doors, does not significantly impact risk assessment. In California, insurers heavily weigh the insured's driving record when determining auto insurance premiums as it provides insight into the likelihood of future claims. Question 31. Workers' compensation insurance. In California, which entity administers the workers' compensation system and oversees the requirements for employers to provide coverage for their employees? A. California Department of Insurance, CDI. B. Division of Workers' Compensation, DOE Employment Development Department, Ed. D. Occupational Safety and Health Administration, OSHA. Answer: B. Division of Workers' Compensation, DOE. Explanation: the Division of Workers' Compensation in California administers the workers' compensation system and oversees the requirements for employers to provide coverage for their employees. The DWC ensures that injured workers receive appropriate benefits and that employers comply with state laws regarding workers' compensation insurance. California Department of Insurance, CDA, regulates insurance practices but does not administer workers' compensation directly. Employment Development Department, ED, administers unemployment insurance and state disability insurance, not workers' compensation. Occupational Safety and Health Administration, OSHA, federal agency responsible for workplace safety, not workers' compensation administration. In California. In California, employers must comply with workers' compensation laws administered by the DWC to protect employees injured on the job. Question 32. Ethics and professional conduct. In the context of insurance industry ethics in California, what is the primary purpose of the principle of utmost good faith? A. To ensure fair treatment of policyholders by insurance companies. B. To provide transparency in insurance policy terms and conditions. C. To encourage insurance companies to offer competitive premiums. D. To protect insurance agents from legal liabilities. Answer: A. To ensure fair treatment of policyholders by insurance companies. Explanation: the principle of utmost good faith requires both parties, the insurer and the insured, to act honestly and fairly in their dealings. It ensures that insurers provide full and accurate information to policyholders and handle claims fairly and promptly. Transparency in policy terms, important but not the primary purpose of utmost good faith. Competitive premiums, determined by market factors and underwriting criteria, not ethical principles. Protection of insurance agents. Their conduct is guided by ethical standards but not the purpose of utmost good faith. In California, adherence to the principle of utmost good faith is essential to maintaining trust and fairness in insurance transactions, benefiting policyholders by ensuring they receive the coverage they expect. Question 33. Insurance industry trends and developments. What emerging trend in California's insurance industry involves the use of technology to assess risk and personalize insurance premiums based on individual behavior? A. Insurtech. B. Cybersecurity insurance. C. Telematics. D. Climate risk modeling. Answer: C. Telematics. Explanation: Telematics is an emerging trend in California's insurance industry that involves using technology such as GPS and sensors to collect data on driving behavior. Insurers use this data to assess risk more accurately and personalize insurance premiums based on individual driving habits. InsurTech refers to the use of technology to enhance efficiency and customer experience in insurance, including telematics. Cybersecurity insurance covers losses related to cyber threats not directly related to telematics. Climate risk modeling involves assessing risks related to climate change and environmental factors. In California, telematics technology allows insurers to offer usage-based insurance policies that reward safe driving behaviors, potentially lowering premiums for policyholders who demonstrate low risk levels. Question 34. Insurance claims. In California, what does the principle of subrogation allow an insurance company to do after settling a claim with its policyholder? A. Cancel the insurance policy. B. Recover expenses from the insured. C. Pursue legal action against the insured. D. Seek reimbursement from third parties responsible for the loss. Answer: D. Seek reimbursement from third parties responsible for the loss. Explanation: Subrogation allows an insurance company, after settling a claim with its policyholder, to pursue reimbursement from third parties who may be responsible for the loss or damage. This helps insurers recover costs and prevents policyholders from receiving double compensation for the same loss. Cancel the insurance policy. Typically done for non-payment or other policy violations not related to subrogation. Recover expenses from the insured. Covered under deductibles or policy limits but not related to subrogation. Pursue legal action against the insured. Uncommon after a claim settlement unless fraud is suspected. In California, subrogation rights are included in insurance policies to mitigate losses and maintain fairness in claim settlements. Question 35. State-specific insurance regulations. Under California insurance regulations, what is the purpose of requiring insurance companies to file rates and forms with the Department of Insurance? A. To ensure consistent premium rates across different insurers. B. To protect consumers from unfair pricing practices. C. To simplify the insurance purchasing process for consumers. D. To reduce competition among insurance companies. Answer: B. To protect consumers from unfair pricing practices. Explanation: In California, requiring insurance companies to file rates and forms with the Department of Insurance serves to protect consumers from unfair pricing practices. This oversight ensures that insurers do not engage in discriminatory pricing or other practices that could harm consumers. Consistent premium rates may vary among insurers based on risk assessment and underwriting criteria. Simplifying the insurance purchasing process. Regulation focuses on fairness and transparency rather than simplification. Reducing competition. Filing requirements promote fair competition by preventing unfair practices. California's regulatory framework aims to uphold consumer rights and maintain a competitive insurance market while ensuring that insurers operate fairly and transparently. Question 36. Insurance policy analysis. Which component of an insurance policy in California specifies the duties and responsibilities of both the insured and the insurer? A. Declarations page. B. Insuring agreements. C. Conditions. D. Exclusions. Answer: C. Conditions. Explanation: The conditions section of an insurance policy in California specifies the duties and responsibilities of both the insured and the insurer. This includes requirements such as prompt claims reporting, cooperation in investigations, and methods for resolving disputes. Declarations page provides basic information about the policyholder and insured property. Insuring agreements outline the scope of coverage and promises made by the insurer. Exclusions specify what is not covered under the policy. Understanding the conditions section is essential for policyholders in California to know their obligations and rights under the insurance contract, ensuring compliance and effective claims handling. Question 37. Casualty insurance. Types of policies. Which type of casualty insurance policy in California typically covers legal expenses and court costs associated with defending against lawsuits for bodily injury or property damage? A. Umbrella liability policy. B. Directors and officers liability policy. C. Errors and omissions policy. D. Commercial general liability (CGL) policy. Answer: D. Commercial general liability (CGL) policy. Explanation: a commercial general liability (CGL) policy in California typically covers legal expenses and court costs associated with defending against lawsuits for bodily injury or property damage. It provides broad coverage for third-party liability claims arising from business operations. Umbrella liability policy provides additional liability coverage above the limits of underlying policies. Directors and officers liability policy covers legal expenses related to lawsuits against corporate directors and officers. Errors and omissions policy covers professional negligence and errors in services provided. In California, businesses often rely on CGL policies to protect against the financial impact of lawsuits alleging bodily injury or property damage caused by their operations. Question 38. Insurance contract formation. In California, which element is necessary for the formation of a valid insurance contract? A. Payment of the policy premium. B. Agreement on the policy limits. C. Certification of the insured's assets. D. Inspection of the insured property. Answer: A. Payment of the policy premium. Explanation: in California, payment of the policy premium is necessary for the formation of a valid insurance contract. This demonstrates the insured's intention to be bound by the terms of the contract, including the insurer's promise to provide coverage, agreement on the policy limits. Part of the negotiations, but not essential for contract formation. Certification of the insured's assets may be required for certain types of insurance, but not for contract formation. Inspection of the insured property helps assess risk but does not determine contract validity. The payment of the premium in California signifies the insured's acceptance of the insurer's offer and completes the formation of the insurance contract. Question 39. Ethics and professional conduct. In the context of insurance industry ethics in California, what does the principle of a fiduciary duty require insurance agents to prioritize? A. Serving the best interests of their clients. B. Maximizing their commission earnings. C. Following state regulations only. D. Marketing insurance products aggressively. Answer: A. Serving the best interests of their clients. Explanation: the principle of fiduciary duty in California requires insurance agents to prioritize serving the best interests of their clients. This includes providing accurate information, recommending suitable products, and acting in the client's best interest. Maximizing commission earnings, not aligned with fiduciary duty, which focuses on client welfare. Following state regulations only, important but does not encompass the comprehensive client-focused approach of fiduciary duty. Marketing insurance products aggressively should be done ethically and with client interests in mind. In California, insurance agents are expected to uphold high ethical standards, including fiduciary duty to build trust and ensure fair treatment of clients in insurance transactions. Question 40. Underwriting considerations. In California, which factor is typically not considered during the underwriting process for homeowners insurance? A. The age of the roof. B. The presence of a swimming pool. C. The homeowner's credit score. D. The proximity to fire hydrants. Answer: C. The homeowner's credit score. Explanation: in California, the homeowner's credit score is typically not considered during the underwriting process for homeowners insurance. Factors such as the age of the roof, the presence of certain amenities like a swimming pool, and the proximity to fire hydrants are more commonly assessed to determine the risk and appropriate premiums. Age of the roof influences the risk of damage and need for replacement. Presence of a swimming pool adds liability risk and maintenance considerations. Proximity to fire hydrants affects fire protection and response times. California insurers focus on factors directly related to property risk when underwriting homeowners insurance policies, rather than personal credit scores. Question 41. Insurance claims handling. In California, what is the primary purpose of the duty to defend a provision in a liability insurance policy? A. To indemnify the insured for covered losses. B. To investigate claims and determine liability. C. To provide legal representation for the insured. D. To negotiate settlements with claimants. Answer: C. To provide legal representation for the insured. Explanation: the duty to defend a provision in a liability insurance policy in California requires the insurer to provide legal representation for the insured when a covered claim or lawsuit is filed. This provision ensures that the insured has access to legal expertise and defense against allegations of liability. Indemnify the insured refers to reimbursing the insured for covered losses, not providing legal defense. Investigate claims, done by the insurer to assess liability and coverage. Negotiate settlements, typically handled by claims adjusters to resolve claims amicably. In California, the duty to defend provision is essential for ensuring fair treatment of policyholders facing lawsuits or claims covered by their liability insurance policies. Question 42. Insurance policy analysis. Which section of an insurance policy in California specifies the circumstances under which coverage will be provided or denied? A. Declarations. B. Insuring agreements. C. Exclusions. D. Conditions. Answer: C. Exclusions. Explanation: the exclusions section of an insurance policy in California specifies the circumstances under which coverage will be denied. This section identifies specific perils, conditions, or types of property that are not covered by the policy, ensuring clarity on what risks are excluded from coverage. Declarations provides basic information about the policyholder insured property and policy limits. Insuring agreements outline the scope of coverage and promises made by the insurer. Conditions specify the rights and responsibilities of both the insured and insurer under the policy. Understanding the exclusions section is crucial for policyholders in California to be aware of potential gaps in coverage and consider additional endorsements or policies for comprehensive protection against specific risks. Question 43. State insurance laws and regulations. In California, what role does the California Department of Insurance, CDIA, play in regulating insurance practices? A. Enforcing traffic laws related to insurance. B. Setting insurance policy premiums. C. Licensing insurance agents and companies. D. Providing legal representation in insurance disputes. Answer: C. Licensing insurance agents and companies. Explanation: the California Department of Insurance, CDI, is responsible for licensing insurance agents and companies operating within the state. This includes ensuring that agents and companies meet educational and ethical standards to protect consumers and maintain a fair insurance marketplace. Enforcing traffic laws, handled by law enforcement agencies, not the CDI. Setting insurance premiums. Rates are set by insurers based on risk and regulatory approval, not directly by the CDI. Providing legal representation. CDI may investigate complaints and enforce laws, but does not provide legal representation. In California, the CDI's licensing process ensures that insurance professionals meet qualifications and adhere to state laws promoting consumer protection and industry standards. Question 44. Insurance industry trends and developments. What impact does climate change have on the property insurance market in California? A. Decreased premiums due to reduced risks. B. Increased availability of coverage options. C. Higher premiums and deductibles. D. Expanded coverage for natural disasters. Answer: C. Higher premiums and deductibles. Explanation: climate change has led to increased frequency and severity of natural disasters in California, such as wildfires and floods. As a result, property insurance premiums and deductibles have risen to reflect the heightened risk and potential for significant losses. Decreased premiums, and likely due to increased risk and losses from climate-related events. Increased availability of coverage options. Insurers may restrict coverage or increase rates to manage risk. Expanded coverage. Insurers may limit coverage or impose exclusions for certain natural disasters. In California, insurers adjust premiums and coverage terms in response to climate change impacts, aiming to manage risks and maintain financial stability in the face of growing environmental challenges. Question 45. Insurance underwriting. In California, what role does an insurance underwriter play in the insurance policy issuance process? A. Selling insurance policies directly to consumers. B. Evaluating risks and determining policy terms. C. Investigating claims and processing payments. D. Advising clients on insurance coverage options. Answer: B. Evaluating risks and determining policy terms. Explanation: an insurance underwriter in California evaluates risks associated with insuring individuals or entities and determines appropriate policy terms, including premiums and coverage limits. This assessment helps insurers price policies accurately and manage their overall risk exposure. Selling insurance policies directly, done by insurance agents or brokers, not underwriters. Investigating claims, handled by claims adjusters to assess coverage and process payments. Advising clients on coverage options, typically done by insurance agents based on underwriting guidelines. In California, underwriters play a crucial role in ensuring that insurance policies are priced competitively while adequately protecting policyholders against potential risks and losses. Question 46. Insurance claims handling. In California, what is the purpose of the reservation of rights letter issued by an insurance company to its policyholder? A. To deny coverage for the claim. B. To confirm coverage and initiate payment. C. To outline potential coverage issues or exclusions. D. To request additional information from the insured. Answer: C. To outline potential coverage issues or exclusions. Explanation: in California, a reservation of rights letter is issued by an insurance company to its policyholder to outline potential coverage issues or exclusions related to the claim being made. This letter informs the insured that while the insurer is investigating the claim, certain aspects of coverage may be subject to limitations or exclusions based on policy terms. Deny coverage for the claim, usually communicated in a formal denial letter, not a reservation of rights. Confirm coverage and initiate payment, indicates acceptance of coverage, not typically a reservation of rights. Request additional information, done separately to gather necessary details for claim processing. The reservation of rights letter is important for policyholders in California to understand potential limitations in coverage and seek legal advice if needed. Question 47. Insurance policy analysis. Which type of insurance policy in California is specifically designed to cover losses related to electronic data breaches and cyber attacks? A. Business interruption insurance. B. Cyber liability insurance. C. Professional liability insurance. D. Errors and omissions insurance. Answer: B. Cyber liability insurance. Explanation: cyber liability insurance in California is specifically designed to cover losses related to electronic data breaches and cyber attacks. This type of policy helps businesses mitigate financial losses and liabilities associated with data breaches, including costs of investigation, notification, and potential legal expenses. Business interruption insurance covers losses from business interruption due to covered perils not specific to cyber incidents. Professional liability insurance covers claims of professional negligence or errors in services provided. Errors and omissions insurance, similar to professional liability, covering claims of mistakes or failure to perform services as promised. In California, cyber liability insurance is essential for businesses handling sensitive data to protect against the growing risks of cyber threats and data breaches. Question 48. Ethics and professional conduct. In California, what ethical principle guides insurance agents and brokers to disclose conflicts of interest to their clients? A. Principle of indemnity. B. Principle of subrogation. C. Principle of utmost good faith. D. Principle of disclosure. Answer: C. Principle of utmost good faith. Explanation: the principle of utmost good faith in California requires insurance agents and brokers to disclose conflicts of interest to their clients. This ethical standard ensures transparency in insurance transactions, allowing clients to make informed decisions about their insurance coverage. Principle of indemnity refers to the principle of restoring the insured to the same financial position prior to a loss. Principle of subrogation allows insurers to pursue third parties responsible for a loss after compensating the insured. Principle of disclosure, broad concept but not specifically tied to conflicts of interest in insurance transactions. In California, adherence to the principle of utmost good faith promotes trust and integrity in insurance dealings, benefiting both clients and the insurance industry. Question 49. Workers' compensation insurance. In California, what benefits are typically covered under workers' compensation insurance for injured employees? A. Medical expenses and lost wages. B. Legal fees and court costs. C. Property damage and repair costs. D. Business interruption losses. Answer A. Medical expenses and lost wages. Explanation: workers' compensation insurance in California typically covers medical expenses and lost wages for employees injured on the job. This coverage ensures that injured workers receive necessary medical treatment and compensation for income lost due to temporary or permanent disability. Legal fees and court costs generally covered under liability insurance policies, not workers' compensation. Property damage and repair costs covered under property insurance policies, not workers' compensation. Business interruption losses covered under business interruption insurance, not workers' compensation. In California, employers are required to provide workers' compensation benefits to protect employees and comply with state laws regarding workplace injuries. Question 50. Insurance policy analysis. In California, what does the insuring agreement section of an insurance policy typically outline? A. The duties and responsibilities of both parties. B. Specific perils covered by the policy. C. Exclusions and limitations of coverage. D. Declarations and basic policy information. Answer: B. Specific perils covered by the policy. Explanation: in California, the insuring agreement section of an insurance policy typically outlines the specific perils or risks covered by the policy. This section defines the scope of coverage provided by the insurer, detailing what events or circumstances trigger coverage under the policy. Duties and responsibilities of both parties, outlined in the conditions section of the policy. Exclusions and limitations of coverage, listed separately to clarify what is not covered. Declarations and basic policy information, found at the beginning of the policy, providing details about the insured and coverage limits. Understanding the insuring agreement section is crucial for policyholders in California to know the extent of protection provided by their insurance policies and ensure adequate coverage for their needs. Question 51. Casualty insurance. Policy provisions. In California, which provision in a liability insurance policy typically covers legal defense costs for claims against the insured? A. Indemnity provision. B. Subrogation clause. C. Duty to defend clause. D. Exclusionary language. Answer: C. Duty to defend clause. Explanation: in California, the duty to defend clause in a liability insurance policy typically covers legal defense costs for claims against the insured. This provision obligates the insurer to provide legal representation and defense services when the insured faces lawsuits or claims covered under the policy. Indemnity provision promises to compensate the insured for covered losses. Subrogation clause allows the insurer to recover losses from third parties after paying a claim. Exclusionary language specifies what is not covered under the policy. The duty to defend clause in California ensures that insured individuals or businesses receive legal support and representation, protecting their interests and rights in liability claims. Question 52. Insurance contracts. Offer and acceptance. In California, what is required for a valid acceptance of an insurance contract offer? A. Signing the insurance policy document. B. Payment of the policy premium. C. Mutual agreement on policy terms. D. Submission of a claim. Answer: C. Mutual agreement on policy terms. Explanation: in California, a valid acceptance of an insurance contract offer requires mutual agreement on the policy terms between the insurer and the insured. This agreement may be expressed orally or in writing, and both parties must consent to the terms of coverage. Signing the insurance policy document formalizes the agreement but is not the initial acceptance requirement. Payment of the policy premium occurs after acceptance to bind the contract but is not acceptance itself. Submission of a claim comes after policy issuance and does not constitute acceptance of the initial offer. Mutual agreement on policy terms in California ensures that both parties understand and agree to the rights, responsibilities, and coverage provided by the insurance contract. Question 53. Ethics and professional conduct. What ethical principle requires insurance agents in California to provide accurate and complete information to clients regarding insurance products. A. Principle of indemnity. B. Principle of subrogation. C. Principle of representation. D. Principle of disclosure. Answer: D. Principle of disclosure. Explanation: the principle of disclosure requires insurance agents in California to provide accurate and complete information to clients regarding insurance products. This ethical standard ensures transparency in insurance transactions, allowing clients to make informed decisions about their coverage options. Principle of indemnity focuses on restoring the insured to the same financial position prior to a loss. Principle of subrogation allows insurers to pursue third parties responsible for a loss after compensating the insured. Principle of representation involves accurately representing insurance products and services but is broader than disclosure. In California, adherence to the principle of disclosure helps build trust between insurance agents and clients, promoting fair and informed insurance purchasing decisions. Question 54. Insurance underwriting. What factor is typically considered by insurers in California when determining the premium for an auto insurance policy? A. Homeowner's credit score. B. Distance driven annually. C. Number of dependents. D. Level of education. Answer: B. Distance driven annually. Explanation: in California, insurers typically consider the distance driven annually when determining the premium for an auto insurance policy. This factor helps assess the risk of accidents and vehicle usage patterns influencing the cost of coverage. Homeowner's credit score. More relevant for homeowners insurance premiums, not auto insurance. Number of dependents. Generally not a factor in auto insurance premium calculations. Level of education. Not directly related to driving risk or insurance premiums. In California, factors such as annual mileage, driving history, and type of vehicle are critical considerations for insurers in determining auto insurance premiums, reflecting the risk of claims and potential costs. Question 55. Insurance claims handling. In California, what role does the appraisal clause in an insurance policy typically serve? A. To determine the cause of a loss. B. To assess the value of damaged property. C. To negotiate settlement terms. D. To resolve disputes over claim amounts. Answer: D. To resolve disputes over claim amounts. Explanation: in California, the appraisal clause in an insurance policy serves to resolve disputes over claim amounts between the insured and the insurer. It allows either party to request an independent appraisal to assess the value of property damage or loss, ensuring a fair and impartial resolution, determining the cause of the loss, investigated separately by claims adjusters to establish coverage. Assessing the value of damaged property, done through appraisal but not the primary role of the clause. Negotiating settlement terms, handled through claims negotiations, not the appraisal clause. The appraisal clause in California provides a mechanism for resolving disagreements over claim amounts, promoting fairness and efficiency in the claims settlement process. Question 56. Insurance policy analysis. Under California insurance regulations, what does the endorsement section of an insurance policy allow for? A. Modification of policy terms. B. Cancellation of coverage. C. Automatic renewal of policies. D. Transfer of policy ownership. Answer: A. Modification of policy terms. Explanation: in California, the endorsement section of an insurance policy allows for the modification of policy terms. Insurers can use endorsements to add, delete, or amend coverage provisions based on the insured's needs or changes in risk exposure. Cancellation of coverage requires compliance with specific cancellation provisions, not part of endorsements. Automatic renewal of policies governed separately by renewal terms in the policy. Transfer of policy ownership, handled through assignment or transfer procedures, not typically part of endorsements. Endorsements in California provide flexibility for insurers and policyholders to customize insurance coverage to better meet evolving needs or regulatory requirements. Question 57. State insurance laws and regulations. In California, what is the purpose of the Unfair Claims Settlement Practices Act? A. To regulate premium rates for insurance policies. B. To protect consumers from deceptive claims handling practices. C. To enforce licensing requirements for insurance agents. D. To establish guidelines for underwriting insurance policies. Answer: B. To protect consumers from deceptive claims handling practices. Explanation: the Unfair Claims Settlement Practices Act in California aims to protect consumers from deceptive claims handling practices by insurance companies. It sets forth guidelines and regulations that insurers must follow when investigating, processing, and settling insurance claims to ensure fair treatment of policyholders. Regulating premium rates, handled through rate filings and regulatory approvals, not part of claims settlement practices. Enforcing licensing requirements, governed by separate laws and regulations for insurance agents. Establishing underwriting guidelines, done to assess risk and determine policy terms not related to claims settlement practices. In California, adherence to the Unfair Claims Settlement Practices Act promotes transparency, fairness, and accountability in insurance claim handling, safeguarding consumer rights and interests. Question 58. Casualty insurance. Liability coverage. In California, what does the per occurrence limit refer to in a liability insurance policy? A. The maximum amount the insurer will pay for all claims during the policy period. B. The deductible amount that the insured must pay per claim. C. The maximum amount the insurer will pay for a single claim or incident. D. The minimum amount of coverage required by law. Answer: C. The maximum amount the insurer will pay for a single claim or incident. Explanation: in California, the per occurrence limit (ICA) liability insurance policy refers to the maximum amount the insurer will pay for a single claim or incident. This limit is specified in the policy and represents the insurer's liability exposure for each covered occurrence. Maximum amount for all claims refers to the aggregate limit, not the per occurrence limit. Deductible amount per claim, paid by the insured before the insurer's coverage kicks in, not related to the per occurrence limit. Minimum amount of coverage required by law, typically set by state regulations, not defined by the per occurrence limit. Understanding the per occurrence limit is important for insured parties in California to assess their coverage adequacy and potential financial exposure in case of liability claims. Question 59. Insurance policy analysis. Which section of an insurance policy in California typically outlines the rights and responsibilities of both the insured and the insurer? A. Declarations. B. Conditions. C. Exclusions. D. Insuring agreements. Answer: B. Conditions. Explanation: in California, the conditions section of an insurance policy typically outlines the rights and responsibilities of both the insured and the insurer. This section includes provisions related to policyholder duties, claims handling procedures, and other contractual obligations that both parties must fulfill. Declarations provides basic information about the insured and policy specifics. Exclusions lists what is not covered under the policy. Insuring agreements defines the scope of coverage and promises made by the insurer. The conditions section in California ensures clarity and compliance with policy terms, helping to mitigate disputes and uphold contractual obligations between the insured and insurer. Question 60. Insurance underwriting. What role does the loss ratio play in insurance underwriting in California? A. It determines the premium calculation for each policyholder. B. It assesses the profitability of an insurance company. C. It establishes underwriting guidelines and rating factors. D. It evaluates the financial stability of an insurer. Answer: B. It assesses the profitability of an insurance company. Explanation: in California, the loss ratio plays a crucial role in insurance underwriting by assessing the profitability of an insurance company. It measures the ratio of claims paid out to premiums earned over a specific period, indicating the insurer's ability to effectively manage risks and generate profits. Determining premium calculation, done based on underwriting guidelines and risk assessment, not directly by loss ratio. Establishing underwriting guidelines, based on risk assessment and regulatory requirements. Evaluating financial stability, assessed through various financial metrics, not solely by loss ratio. The loss ratio in California helps insurers make informed underwriting decisions, adjust pricing strategies, and maintain financial stability while fulfilling obligations to policyholders. Question 61. Ethics and professional conduct. In California, what ethical principle guides insurance agents and brokers to prioritize the interests of their clients above their own? A. Principle of indemnity. B. Principle of subrogation. C. Principle of representation. D. Principle of fiduciary duty. Answer: D. Principle of fiduciary duty. Explanation: in California, the principle of fiduciary duty guides insurance agents and brokers to prioritize the interests of their clients above their own. This ethical standard requires agents to act in the best interests of their clients, maintaining trust, honesty, and integrity in all insurance transactions. Principle of indemnity focuses on compensating the insured for covered losses. Principle of subrogation allows insurers to recover losses from third parties after paying a claim. Principle of representation involves accurately representing insurance products and services, but is broader than fiduciary duty. Adherence to the principle of fiduciary duty in California ensures that insurance professionals provide objective advice and recommendations that align with their clients' needs and preferences. Question 62. State insurance laws and regulations. Under California insurance regulations, what is the purpose of rate regulation by the California Department of Insurance? A. To limit the number of insurance companies operating in the state. B. To ensure insurance policies are affordable for consumers. C. To establish uniform insurance policy terms and conditions. D. To approve insurance premium rates for fairness and solvency. Answer: D. To approve insurance premium rates for fairness and solvency. Explanation: in California, rate regulation by the California Department of Insurance involves approving insurance premium rates to ensure fairness, affordability, and the financial solvency of insurance companies. This regulatory process protects consumers from excessive rates and ensures that insurers can meet their obligations. Limiting insurance companies done through licensing and regulatory oversight, not rate regulation. Affordability of insurance policies, addressed indirectly through rate approval and market competition. Uniform policy terms. Policy terms are subject to general contract law and regulatory guidelines, not set uniformly by rate regulation. Rate regulation in California promotes a balanced insurance marketplace where insurers could compete while offering fair and sustainable premium rates to policyholders. Question 63. Insurance claims handling. In California, what is the purpose of the reservation of rights letter issued by an insurance company to its policyholder? A. To confirm coverage and initiate payment. B. To deny coverage for the claim. C. To outline potential coverage issues or exclusions. D. To request additional information from the insured. Answer: C. To outline potential coverage issues or exclusions. Explanation: in California, a reservation of rights letter is issued by an insurance company to its policyholder to outline potential coverage issues or exclusions related to the claim being made. This letter informs the insured that while the insurer is investigating the claim, certain aspects of coverage may be subject to limitations or exclusions based on policy terms. Confirming coverage and initiating payment indicates acceptance of coverage, not typically a reservation of rights. Denying coverage for the claim, usually communicated in a formal denial letter, not a reservation of rights. Requesting additional information, done separately to gather necessary details for claim processing. The reservation of rights letter in California is important for policyholders to understand potential limitations in coverage and seek legal advice if needed to protect their interests. Question 64. Insurance policy analysis. In California, what does the declarations page of an insurance policy typically include? A. Detailed policy terms and conditions. B. Premium payment schedule. C. Names of insured parties and property covered. D. Claims handling procedures. Answer: C. Names of insured parties and property covered. Explanation: in California, the declarations page of an insurance policy typically includes specific details such as the names of insured parties and the property covered under the policy. It serves as a summary of key information related to the insurance coverage provided. Detailed policy terms and conditions, found throughout the policy document, not just on the declarations page. Premium payment schedule, typically outlined in separate sections or endorsements. Claims handling procedures, detailed in the conditions or claims section of the policy. Understanding the declarations page in California helps policyholders verify coverage details and ensure accuracy in their insurance documentation. Question 65. Insurance industry trends and developments. In California, how does technological advancement impact the insurance industry? A. Reducing the need for insurance agents. B. Increasing insurance fraud. C. Enhancing underwriting and claims processing. D. Lowering insurance premiums. Answer: C. Enhancing underwriting and claims processing. Explanation: in California, technological advancements in the insurance industry enhance underwriting and claims processing capabilities. Technologies such as artificial intelligence, AI, big data analytics, and digital platforms enable insurers to assess risks more accurately, streamline operations, and improve customer service, reducing the need for insurance agents. Technology supports agents but does not replace their role in client relationships. Increasing insurance fraud. Technology also enhances fraud detection capabilities, reducing fraud rates, lowering insurance premiums. Rates are influenced by various factors, with technology potentially reducing operational costs but not necessarily premiums. Technological advancements in California's insurance industry drive efficiency, innovation, and improved service delivery, benefiting both insurers and policyholders. Question 66. Insurance underwriting. In California, what factor typically influences the underwriting decision for a homeowner's insurance policy? A. Vehicle make and model. B. Location of the property. C. Credit score of the insured. D. Health history of the insured. Answer: B. Location of the property. Explanation: in California, the location of the property typically influences the underwriting decision for a homeowner's insurance policy. Factors such as proximity to coastlines, wildfire risk zones, crime rates, and local building codes impact the likelihood of claims and the cost of coverage. Vehicle make and model. Relevant to auto insurance underwriting, not homeowners insurance. Credit score of the insured. May affect insurance premiums but is not a primary factor in homeowners underwriting. Health history of the insured. Irrelevant to property insurance underwriting considerations. Understanding how location affects underwriting decisions in California helps insurers assess risk accurately and determine appropriate coverage terms for homeowners. Question 67. Insurance contracts. Offer and acceptance. In California, what constitutes a valid offer in the formation of an insurance contract? A. An invitation to negotiate terms. B. A promise to consider coverage. C. A proposal containing specific terms. D. A general discussion on insurance options. Answer: C. A proposal containing specific terms. Explanation: in California, a valid offer in the formation of an insurance contract consists of a proposal containing specific terms. This proposal outlines the coverage details and terms under which the insurer is willing to provide insurance, serving as the basis for negotiation and acceptance. Invitation to negotiate terms. Preliminary stage before a formal offer is made. Promise to consider coverage. Indicates intent but does not constitute a formal offer. General discussion on insurance options. Informative but lacks specificity required for a formal offer. A clear and specific proposal in California ensures mutual understanding and forms the basis for the insurance contract's terms and conditions. Question 68. Casualty insurance. Types of policies. Which type of casualty insurance policy in California typically covers legal liabilities arising from bodily injury or property damage caused by an insured's negligence? A. Comprehensive general liability. B. Business interruption. C. Workers' compensation. D. Professional liability. Answer: A. Comprehensive general liability. Explanation: in California, a comprehensive general liability (CGL) insurance policy typically covers legal liabilities arising from bodily injury or property damage caused by an insured's negligence. This type of policy protects businesses and individuals from claims related to accidents or incidents occurring on their premises or as a result of their operations. Business interruption covers losses from business interruption due to covered perils. Workers' compensation covers injuries to employees arising out of and in the course of employment. Professional liability covers claims of negligence or errors in professional services. Understanding the coverage provided by A CGL policy in California helps insured parties mitigate financial risks associated with legal liabilities and negligence claims. Question 69. Ethics and professional conduct. Under California insurance regulations, what ethical principle requires insurance agents to provide honest and accurate information about insurance products and services? A. Principle of indemnity. B. Principle of subrogation. C. Principle of representation. D. Principle of honesty. Answer: C. Principle of representation. Explanation: in California, the principle of representation requires insurance agents to provide honest and accurate information about insurance products and services to clients. This ethical standard ensures transparency and helps clients make informed decisions regarding their insurance needs. Principle of indemnity focuses on compensating the insured for covered losses. Principle of subrogation allows insurers to recover losses from third parties after paying a claim. Principle of honesty, general ethical principle but not specific to representation of insurance products. Adherence to the principle of representation in California promotes professionalism, trust and integrity in insurance agent-client relationships benefiting both parties involved. Question 70. Insurance claims handling. In California, what is the purpose of the examination under oath in the context of insurance claims? A. To assess the insured's credibility. B. To determine the cause of the loss. C. To estimate the value of the claim. D. To negotiate settlement terms. Answer A. To assess the insured's credibility. Explanation: in California, an examination under oath during insurance claims handling serves the purpose of assessing the insured's credibility regarding the circumstances of the claim. This process involves the insurer conducting a formal interview where the insured provides sworn testimony, often under penalty of perjury, to verify the accuracy and legitimacy of the claim. Determining the cause of the loss, investigated separately through claims adjustment processes, estimating the value of the claim, assessed based on evidence and documentation provided, negotiating settlement terms, done after a claims investigation and assessment. The examination under oath in California helps insurers gather accurate information, prevent fraud, and ensure compliance with policy terms, ultimately facilitating fair claims settlements. Question 71. Insurance policy analysis. Under California insurance regulations, what is the purpose of the endorsement section in an insurance policy? A. To modify or amend policy terms. B. To cancel the policy. C. To renew the policy automatically. D. To transfer ownership of the policy. Answer A. To modify or amend policy terms. Explanation: in California, the endorsement section of an insurance policy allows for the modification or amendment of policy terms. Insurers use endorsements to add, delete, or change coverage provisions to better meet the insured's needs or comply with regulatory requirements. Canceling the policy requires compliance with specific cancellation provisions not part of endorsements. Automatic renewal, governed separately by renewal terms in the policy. Transferring ownership, handled through assignment or transfer procedures not typically part of endorsements. Endorsements in California provide flexibility for insurers and policyholders to tailor insurance coverage to specific circumstances or regulatory changes effectively. Question 72. Insurance underwriting. In California, what factor typically influences the underwriting decision for a life insurance policy? A. Credit history of the insured. B. Annual income of the insured. C. Health status and medical history. D. Driving record of the insured. Answer: C. Health status and medical history. Explanation: in California, the health status and medical history of the insured typically influence the underwriting decision for a life insurance policy. Insurers assess the applicant's health to determine the level of risk associated with providing coverage and calculating appropriate premiums. Credit history, generally not a factor in life insurance underwriting decisions. Annual income may affect the amount of coverage but is not a primary underwriting factor. Driving record, relevant for auto insurance underwriting, not life insurance. Understanding the importance of health status and medical history in California's life insurance underwriting process helps applicants prepare for requirements and potential premium adjustments based on health-related risks. Question 73. State insurance laws and regulations. Under California insurance regulations, what is the purpose of the duty of disclosure for insurance applicants? A. To ensure accurate premium calculation. B. To provide personal financial information. C. To disclose material facts that may affect coverage. D. To waive rights to legal action. Answer. C. To disclose material facts that may affect coverage. Explanation. In California, the duty of disclosure requires insurance applicants to disclose material facts that may affect coverage decisions by insurers. This obligation ensures transparency and helps insurers assess risk accurately when underwriting policies. Accurate premium calculation depends on disclosed information but not the primary purpose of duty of disclosure. Personal financial information may be requested for certain types of insurance but not the core focus of duty of disclosure. Waiving rights to legal action, typically addressed through contractual terms and conditions not related to duty of disclosure. Adherence to the duty of disclosure in California helps maintain fairness in insurance transactions and prevents disputes arising from undisclosed material information. Question 74. Insurance industry trends and developments. How does climate change impact property insurance in California? A. Decreases insurance premiums. B. Increases availability of coverage. C. Influences risk assessment and pricing. D. Standardizes policy terms and conditions. Answer. C. Influences risk assessment and pricing. Explanation. In California, climate change impacts property insurance by influencing risk assessment and pricing. Increasing occurrences of wildfires, floods, and other climate-related events necessitate insurers to reassess risk exposure and adjust premiums accordingly to reflect the heightened risk. Decreasing insurance premiums, and likely due to increased risk and potential for higher claims. Increasing availability of coverage often decreases as insurers limit exposure in high-risk areas. Standardizing policy terms varied by insurer and regulatory guidelines, not universally affected by climate change. Climate change in California prompts insurers to adopt proactive measures such as revising underwriting guidelines and adjusting policy terms to manage risks effectively and ensure sustainable insurance operations. Question 75. Ethics and professional conduct. In California, what ethical principle guides insurance agents to avoid conflicts of interest and prioritize client interests? A. Principle of indemnity. B. Principle of subrogation. C. Principle of representation. D. Principle of loyalty. Answer. D. Principle of loyalty. Explanation. In California, the principle of loyalty guides insurance agents to avoid conflicts of interest and prioritize the interests of their clients above their own. This ethical standard requires agents to act with integrity, disclose potential conflicts, and maintain loyalty to their clients' best interests. Principle of indemnity focuses on compensating the insured for covered losses. Principle of subrogation allows insurers to recover losses from third parties after paying a claim. Principle of representation involves accurately representing insurance products and services, but is broader than loyalty. Adherence to the principle of loyalty in California ensures trust and professionalism in insurance agent-client relationships, fostering long-term partnerships based on mutual respect and transparency. Question 76. Insurance claims handling. In California, what does the term actual cash value typically refer to in property insurance claims? A. The replacement cost of the property. B. The market value of the property. C. The cost to rebuild the property. D. The depreciated value of the property. Answer. D. The depreciated value of the property. Explanation. In California, an actual cash value in property insurance claims typically refers to the depreciated value of the property at the time of loss. It considers factors such as age, condition, and wear and tear to determine the fair market value of the property immediately before the loss occurred. Replacement cost, the cost to replace or repair the property with new materials of like kind and quality. Market value, the price at which the property would sell in the open market. Cost to rebuild, The expense of reconstructing the property at current prices. Understanding natural cash value in California helps policyholders and insurers accurately assess property losses and determine appropriate claims settlements based on fair market valuations. Question 77. Insurance policy analysis. Under California insurance regulations, what is the purpose of the insuring agreement section in an insurance policy? A. To outline policy exclusions and limitations. B. To define the scope of coverage provided. C. To establish premium payment terms. D. To specify claims handling procedures. Answer. B. To define the scope of coverage provided. Explanation. In California, the insuring agreement section of an insurance policy defines the scope of coverage provided by outlining the risks and perils insured against, as well as the obligations of the insurer to pay for covered losses or damages. Policy exclusions and limitations, detailed in separate sections of the policy. Premium payment terms, typically outlined in the conditions or endorsements of the policy. Claims handling procedures, specified in the claims section of the policy. The insuring agreement in California ensures clarity and mutual understanding of the insurance coverage provided, helping policyholders make informed decisions and insurers fulfill their contractual obligations. Question 78. Insurance underwriting. In California, what role does the insurance score play in the underwriting process for personal insurance policies? A. It assesses the insured's financial stability. B. It evaluates the insured's driving record. C. It predicts the likelihood of insurance claims. D. It determines the insured's creditworthiness. Answer. C. It predicts the likelihood of insurance claims. Explanation. In California, the insurance score plays a role in the underwriting process by predicting the likelihood of insurance claims based on various factors such as credit history, claims history, and other relevant data. Insurers use this score to assess risk and determine appropriate premiums for personal insurance policies. Assessing financial stability, done separately through financial statements and credit reports. Evaluating driving record, relevant for auto insurance underwriting, not typically for all personal insurance policies. Determining creditworthiness, assessed for certain types of insurance but not the primary role of insurance score. Understanding the impact of the insurance score in California helps insurers make data-driven underwriting decisions, enhancing accuracy in risk assessment and pricing for policyholders. Question 79. Insurance contracts. Conditions and endorsements. In California, what is the purpose of an endorsement in an insurance policy? A. To cancel the policy. B. To renew the policy automatically. C. To modify or amend policy terms. D. To transfer ownership of the policy. Answer. C. To modify or amend policy terms. Explanation. In California, an endorsement in an insurance policy is used to modify or amend policy terms. It allows insurers to add, delete, or change coverage provisions to better suit the insured's needs or comply with regulatory requirements without issuing an entirely new policy. Canceling the policy, done through specific cancellation procedures, not through an endorsement. Automatic renewal, governed by renewal terms and conditions, separate from endorsements. Transferring ownership, typically handled through assignment or transfer procedures, not through an endorsement. Endorsements in California provide flexibility for insurers and policyholders to adjust coverage terms as circumstances change, ensuring policies remain relevant and effective. Question 80. Insurance claims handling. Under California insurance regulations, what does subrogation refer to in the context of insurance claims? A. Insurer's right to recover losses from third parties. B. Insurer's obligation to settle claims promptly. C. Insurer's duty to investigate claims thoroughly. D. Insurer's liability for policy coverage. Answer A. Insurer's right to recover losses from third parties. Explanation. In California, subrogation refers to the insurer's right to recover losses from third parties responsible for causing an insurance claim. After paying a claim, the insurer may pursue legal action against the party at fault to recover the amount paid to the insured. Obligation to settle claims promptly, governed by claims handling procedures and regulatory requirements. Duty to investigate claims thoroughly, essential for accurate claim assessment but separate from subrogation rights. Liability for policy coverage, determines the extent of coverage based on policy terms and conditions. Understanding subrogation in California helps insurers mitigate losses and maintain financial stability by recovering funds from responsible parties, by reducing the overall cost of claims. Question 81. Insurance industry trends and developments. How do emerging risks and exposures impact insurance underwriting in California? A. They simplify risk assessment. B. They increase competition among insurers. C. They require new underwriting guidelines. D. They lower insurance premiums. Answer: C. They require new underwriting guidelines. Explanation: in California, emerging risks and exposures impact insurance underwriting by requiring insurers to develop new underwriting guidelines to assess and manage these evolving risks effectively. Examples include cybersecurity threats, climate change-related risks, and technological advancements affecting various industries. Simplifying risk assessment. Emerging risks often complicate rather than simplify risk assessment. Increasing competition depends on market dynamics and regulatory environment, not directly linked to emerging risks. Lowering insurance premiums. Rates are influenced by various factors, with emerging risks potentially increasing premiums due to increased exposure. Adapting underwriting guidelines in California to address emerging risks ensures insurers can accurately assess and price risks, maintain profitability, and provide sustainable coverage to policyholders in a changing environment. Question 82. Casualty insurance. Liability and legal concepts. In California, what legal concept applies when an insurance policyholder transfers their right to recover damages to the insurer after the insurer has paid? A claim. A. Subrogation. B. Indemnity. C. Estoppel. D. Contribution. Answer: A. Subrogation. Explanation: in California, subrogation is the legal concept where an insurance company, after paying a claim, has the right to pursue a third party that caused the loss to recover the amount of the claim paid to the insured. This process helps prevent the insured from collecting twice for the same loss and allows the insurer to recover its costs. Indemnity refers to compensation for a loss or damage suffered. Estoppel prevents a person from asserting a claim or right that contradicts what they previously stated. Contribution, sharing of costs or liabilities among multiple parties. Understanding subrogation in California ensures clarity on the rights and responsibilities of insurers and policyholders in recovering losses from third parties. Question 83. Insurance policy analysis. Under California insurance regulations, what does the insuring clause of an insurance policy typically specify? A. The policy premium payment schedule. B. The insurer's obligations to provide coverage. C. The policyholder's duties after a loss. D. The process for filing a claim. Answer: B. The insurer's obligations to provide coverage. Explanation: in California, the insuring clause of an insurance policy typically specifies the insurer's obligations to provide coverage for the risks and perils stated in the policy. It outlines the scope and limitations of coverage as well as the conditions under which the insurer will compensate the insured for covered losses. Policy premium payment schedule, outlined separately in the policy's premium section. Policyholders' duties after a loss, described in the conditions or duties section of the policy. Process for filing a claim, detailed in the claims handling procedures section. The insuring clause in California helps policyholders understand what risks are covered by their insurance policy and under what circumstances they can make a claim for compensation. Question 84. Ethics and professional conduct. In California, what ethical principle requires insurance agents to act with integrity and disclose all material facts to their clients? A. Principle of indemnity. B. Principle of subrogation. C. Principle of representation. D. Principle of Hones. Answer: D. Principle of honesty. Explanation: in California, the principle of honesty requires insurance agents to act with integrity and disclose all material facts to their clients. This ethical standard ensures transparency in insurance transactions and helps clients make informed decisions about their insurance needs. Principle of indemnity focuses on compensating the insured for covered losses. Principle of subrogation allows insurers to recover losses from third parties after paying a claim. Principle of representation involves accurately representing insurance products and services, but is broader than honesty. Adherence to the principle of honesty in California promotes trust and professionalism in insurance agent-client relationships, enhancing consumer protection and ethical conduct in the industry. Question 85. Workers' compensation insurance. In California, what is the primary purpose of workers' compensation insurance? A. To protect employers from lawsuits filed by injured employees. B. To provide medical and wage benefits to employees injured on the job. C. To cover property damage caused by employees at the workplace. D. To compensate employees for overtime work. Answer: B. To provide medical and wage benefits to employees injured on the job. Explanation: in California, the primary purpose of workers' compensation insurance is to provide medical and wage benefits to employees who are injured or become ill as a result of their job duties. This coverage helps employees recover and return to work while protecting employers from liability for workplace injuries. Protecting employers from lawsuits. Workers' compensation insurance generally prevents employees from suing employers for workplace injuries. Covering property damage. Typically covered under commercial property insurance, not workers' compensation. Compensating for overtime work. Handled through wage agreements and labor laws, not workers' compensation. Understanding the purpose of workers' compensation insurance in California ensures compliance with state regulations and provides essential benefits to injured workers and their families. Question 86. Insurance underwriting. In California, what is a common factor considered in underwriting auto insurance policies? A. Age and marital status of the insured. B. Type and model of the insured vehicle. C. Number of years in the insurance industry. D. Educational background of the insured. Answer: B. Type and model of the insured vehicle. Explanation: in California, a common factor considered in underwriting auto insurance policies is the type and model of the insured vehicle. Insurers assess factors such as the vehicle's make, model, age, safety features, and usage to determine the level of risk and appropriate premium rates. Age and marital status can influence premiums, but as secondary factors. Years in the insurance industry pertains to experience but not directly related to underwriting auto insurance. Educational background generally not a significant factor in auto insurance underwriting. Understanding how vehicle characteristics impact underwriting decisions in California helps insurers accurately assess risk and provide appropriate coverage options to policyholders. Question 87. State insurance laws and regulations. Under California insurance regulations, what is the purpose of the free look period for insurance policies? A. To allow policyholders to cancel the policy and receive a refund. B. To provide policyholders with a grace period for premium payment. C. To permit policyholders to change their coverage options. D. To offer policyholders additional coverage at no extra cost. Answer: A. To allow policyholders to cancel the policy and receive a refund. Explanation: in California, the free look period for insurance policies allows policyholders to review their policy terms after purchase. During this period, policyholders have the option to cancel the policy and receive a refund of premiums paid, providing an opportunity to reconsider their coverage needs without financial penalty. Grace period for premium payment. Separate provision related to payment deadlines. Changing coverage options can be done through policy endorsements or amendments, not typically part of the free look period. Offering additional coverage typically requires payment of additional premiums not provided free during the free look period. Understanding the purpose of the free look period in California helps policyholders make informed decisions about their insurance coverage and ensures consumer protection in the insurance market. Question 88. Insurance contracts. Offer and acceptance. In California, what constitutes acceptance of an insurance contract offer by the insured? A. Payment of the premium. B. Signing the policy document. C. Verbal agreement with the agent. D. Receiving the policy renewal notice. Answer: A. Payment of the premium. Explanation: in California, acceptance of an insurance contract offer by the insured typically occurs when the insured pays the premium required by the insurer. This action indicates the insured's intention to enter into the contract under the terms and conditions outlined by the insurer. Signing the policy document. formalizes the agreement but is not necessarily acceptance. Verbal agreement with the agent may express intent but does not constitute acceptance without payment. Receiving the policy renewal notice informs the insured of renewal terms but is not acceptance of the initial offer. Understanding acceptance in California helps insured parties comply with contractual obligations and ensures clarity in the formation of insurance contracts. Question 89. Insurance claims handling. Under California insurance regulations, what is the purpose of the reservation of rights letter sent by an insurer to a policyholder? A. To deny the claim outright. B. To acknowledge receipt of the claim. C. To reserve the right to deny coverage. D. To offer a settlement amount. Answer: C. To reserve the right to deny coverage. Explanation: in California, a reservation of rights letter sent by an insurer to a policyholder serves the purpose of reserving the insurer's right to deny coverage for a claim in the future. It allows the insurer to investigate the claim further without waiving its rights to contest coverage based on policy terms or legal grounds. Denying the claim outright, done if coverage is clearly excluded or not applicable. Acknowledging receipt of the claim confirms receipt but does not imply coverage or denial. Offering a settlement amount, typically done after coverage is confirmed and liability is established. The reservation of rights letter in California ensures transparency and notifies the policyholder of potential coverage issues, allowing them to respond appropriately during the claims handling process. Question 90. Insurance industry trends and developments. How does advancements in technology impact the insurance industry in California? A. Reduces the need for underwriting. B. Increases operational efficiency. C. Lowers insurance premiums. D. Limits policy customization. Answer: B. Increases operational efficiency. Explanation: advancements in technology impact the insurance industry in California by increasing operational efficiency. Technologies such as artificial intelligence, data analytics, and digital platforms streamline processes such as underwriting, claims handling, and customer service, leading to improved service delivery and cost savings for insurers. Reduction in underwriting. Technology enhances underwriting accuracy and speed but does not eliminate the need. Lowering insurance premiums. Rates are influenced by various factors, with technology contributing to risk assessment and management. Limiting policy customization. Technology allows for more personalized and flexible policy options, contrary to limiting customization. Understanding the impact of technology in California's insurance industry helps insurers adapt to evolving market demands and provide enhanced services to policyholders and stakeholders. Question 91. Insurance policy analysis. Under California insurance regulations, what does the declarations page of an insurance policy typically include? A. Policy endorsements and amendments. B. Policyholders' contact information. C. Insuring agreements and coverage limits. D. Claims handling procedures. Answer: C. Insuring agreements and coverage limits. Explanation: in California, the declarations page of an insurance policy typically includes essential information such as the insuring agreements, coverage limits, deductibles, premium amount, policy period, and any additional insureds or endorsements attached to the policy. It provides a summary of the key terms and conditions of the insurance coverage. Policy endorsements and amendments. Listed separately in the policy's endorsements section. Policyholders' contact information. Generally not part of the declarations page. Claims handling procedures, detailed in the claims section of the policy. Understanding the declarations page in California helps policyholders and stakeholders quickly access vital information about their insurance coverage and obligations. Question 92. Ethics and professional conduct. In California, what ethical principle guides insurance agents to avoid conflicts of interest and act in the best interests of their clients? A. Principle of indemnity. B. Principle of subrogation. C. Principle of representation. D. Principle of loyalty. Answer: D. Principle of loyalty. Explanation: in California, the principle of loyalty guides insurance agents to avoid conflicts of interest and prioritize the interests of their clients above their own. This ethical standard requires agents to act with integrity, disclose potential conflicts, and maintain loyalty to their clients' best interests. Principle of indemnity focuses on compensating the insured for covered losses. Principle of subrogation allows insurers to recover losses from third parties after paying a claim. Principle of representation involves accurately representing insurance products and services, but is broader than loyalty. Adherence to the principle of loyalty in California ensures trust and professionalism in insurance agent-client relationships, fostering long-term partnerships based on mutual respect and transparency. Question 93. State insurance laws and regulations. Under California insurance regulations, what is the purpose of the Fair Claims Practices Regulations? A. To speed up the claims settlement process. B. To prevent insurance fraud. C. To ensure fair treatment of policyholders. D. To reduce insurance premiums. Answer: C. To ensure fair treatment of policyholders. Explanation: in California, Fair Claims Practices Regulations aim to ensure fair treatment of policyholders during the claims handling process. These regulations establish standards for insurers in investigating, evaluating, and settling insurance claims promptly and fairly without unreasonable delay or denial. Speeding up claims settlement aims to ensure timely but fair settlement, not just speed. Preventing insurance fraud, handled through separate anti-fraud measures and investigations. Reducing insurance premiums, not directly related to claims handling regulations. Compliance with Fair Claims Practices Regulations in California protects policyholders from unfair claims practices and maintains consumer confidence in the insurance industry. Question 94. Insurance claims handling. In California, what is the purpose of the duty to defend provision in liability insurance policies? A. To indemnify the insured for covered losses. B. To investigate and evaluate claims. C. To provide legal defense for covered claims. D. To subrogate claims against third parties. Answer: C. To provide legal defense for covered claims. Explanation: in California, the duty to defend a provision in liability insurance policies requires the insurer to provide legal defense for the insured against covered claims or lawsuits. This includes hiring legal counsel, conducting investigations, and covering legal expenses related to defending the insured's interests in court. Indemnifying the insured involves compensating the insured for covered losses separate from defense costs. Investigating and evaluating claims, initial steps in the claims handling process but distinct from providing legal defense. Subrogating claims involves recovering losses from third parties after paying a claim unrelated to the duty to defend. Understanding the duty to defend in California ensures that insured parties receive appropriate legal protection and support from their insurers when facing covered liability claims. Question 95. Insurance underwriting. What role do underwriting guidelines play in the insurance underwriting process in California? A. They ensure compliance with regulatory standards. B. They streamline the claims handling process. C. They assess the financial stability of insurers. D. They evaluate and manage risks. Answer: D. They evaluate and manage risks. Explanation: in California, underwriting guidelines play a crucial role in the insurance underwriting process by evaluating and managing risks associated with potential policyholders or insured risks. These guidelines help insurers assess factors such as loss history, demographics, geographic location, and other risk indicators to determine coverage, eligibility, and premium rates. Ensuring compliance with regulatory standards, handled separately through regulatory oversight and compliance measures. Streamlining claims handling primarily involves claims management procedures, not underwriting guidelines. Assessing financial stability, done through financial analysis and regulatory reporting, not directly part of underwriting guidelines. Understanding underwriting guidelines in California enables insurers to make informed decisions about risk selection and pricing, ensuring sustainable and profitable insurance operations. Question 96. Insurance industry trends and developments. How do regulatory changes impact insurance practices in California? A. They increase competition among insurers. B. They lower insurance premiums. C. They require adjustments in policy terms. D. They simplify claims handling. Answer: C. They require adjustments in policy terms. Explanation: in California, regulatory changes often require insurers to adjust policy terms and conditions to comply with new laws, regulations, or guidelines imposed by state authorities. These changes may impact coverage offerings, premium rates, underwriting practices, and claims handling procedures to ensure compliance and consumer protection, increasing competition among insurers, influenced by market dynamics and consumer demand, not directly by regulatory changes, lowering insurance premiums. Rates are influenced by various factors, with regulatory changes affecting pricing indirectly. Simplifying claims handling depends on the nature of the regulatory changes and their implementation, not the direct outcome of regulatory adjustments. Understanding the impact of regulatory changes in California helps insurers navigate compliance requirements and adapt their operations to meet evolving regulatory standards while maintaining quality service and consumer trust. Question 97. Casualty insurance. Coverage and exclusions. Under California insurance regulations, what is typically excluded from a standard liability insurance policy? A. Property damage caused by insured's negligence. B. Bodily injury to third parties. C. Legal defense costs. D. Business interruption losses. Answer: D. Business interruption losses. Explanation: in California, standard liability insurance policies typically exclude coverage for business interruption losses. These policies are designed to provide coverage for bodily injury and property damage caused by the insured's negligence or other covered perils, but they do not extend to financial losses resulting from business interruptions or closures. Property damage caused by insured's negligence, often covered under liability policies, subject to policy terms. Bodily injury to third parties, primary coverage area for liability insurance policies. Legal defense costs, included under the duty to defend provision of liability policies. Understanding exclusions in liability insurance policies in California helps ensure parties identify gaps in coverage and consider additional insurance products to mitigate specific risks. Question 98. Insurance policy analysis. In California, what is the purpose of an insurance policy's exclusions section? A. To limit the insurer's liability. B. To specify premium payment terms. C. To outline claims handling procedures. D. To define policy endorsements. Answer: A. To limit the insurer's liability. Explanation: in California, though exclusions a section of an insurance policy serves the purpose of limiting the insurer's liability by specifying situations, risks, or events that are not covered under the policy, these exclusions help insurers manage risk exposure and maintain financial stability by excluding certain types of losses or liabilities from coverage. Specifying premium payment terms. Covered in the premium section of the policy. Outlining claims handling procedures, detailed in the claims section of the policy. Defining policy endorsements. Amendments or modifications to policy terms separate from exclusions. Understanding the exclusions section in California insurance policies helps ensure parties understand the scope of coverage and potential limitations, allowing them to make informed decisions about risk management and insurance needs. Question 99. State insurance laws and regulations. Under California insurance regulations, what is the purpose of the guarantee fund for policyholders? A. To reimburse policyholders for insurance fraud losses. B. To provide additional coverage beyond policy limits. C. To compensate policyholders of insolvent insurers. D. To reduce insurance premiums. Answer: C. To compensate policyholders of insolvent insurers. Explanation: in California, the guarantee fund for policyholders serves the purpose of compensating policyholders in the event that an insurance company becomes insolvent and is unable to fulfill its obligations. This fund ensures that policyholders receive at least a minimum level of protection and compensation for covered claims when an insurer is unable to pay due to financial insolvency, reimbursing policyholders for insurance fraud losses, handled through anti-fraud measures and investigations, not the guarantee fund. Providing additional coverage. Policies have specified limits, and the guarantee fund compensates up to certain limits for insolvent insurers, reducing insurance premiums. Funded by insurers and does not directly impact premium rates. Understanding the guarantee fund in California provides reassurance to policyholders about financial security and protection against insurer insolvency in the insurance market. Question 100. Insurance contracts. Conditions and endorsements. Under California insurance regulations, what do endorsements refer to in an insurance policy? A. Additional coverage options. B. Policyholders' contact information. C. Claims handling procedures. D. Premium payment schedule. Answer A. Additional coverage options. Explanation. In California, endorsements in an insurance policy refer to amendments or modifications that add, delete, or change coverage terms and conditions beyond the standard policy provisions. These endorsements allow policyholders to customize their insurance coverage to meet specific needs or circumstances. Policyholders' contact information, typically listed separately in policy details, not as endorsements. Claims handling procedures, outlined in the claims section of the policy. Premium payment schedule, described in the premium payments section. Understanding endorsements in California insurance policies helps policyholders and insurers clarify coverage details and ensure that policies accurately reflect the insured risks and liabilities. Question 101. Insurance underwriting. What role does the loss control function play in insurance underwriting in California? A. Assessing and managing risks. B. Investigating claims. C. Setting premium rates. D. Providing legal advice. Answer A. Assessing and managing risks. Explanation. In California, the loss control function in insurance underwriting involves assessing and managing risks associated with potential policyholders or insured risks. Loss control measures aim to reduce the frequency and severity of losses through proactive risk management strategies, inspections, safety training, and recommendations for risk mitigation. Investigating claims, done separately during the claims handling process. Setting premium rates, influenced by underwriting assessments but not the primary role of loss control. Providing legal advice, handled by legal professionals, not loss control specialists. Understanding the role of loss control in California insurance underwriting helps insurers make informed decisions about risk acceptance, pricing, and policy terms to enhance profitability and maintain sustainable operations. Question 102. Ethics and professional conduct. In California, what ethical principle guides insurance agents to provide accurate information about insurance products and services? A. Principle of indemnity. B. Principle of representation. C. Principle of subrogation. D. Principle of disclosure. Answer. D. Principle of disclosure. Explanation. In California, the principle of disclosure guides insurance agents to provide accurate and complete information about insurance products and services to clients. This ethical principle emphasizes transparency, honesty, and clarity in communication to ensure that clients can make informed decisions about their insurance needs. Principle of indemnity focuses on compensating the insured for covered losses. Principle of representation involves accurately representing insurance products and services, broader than disclosure. Principle of subrogation allows insurers to recover losses from third parties after paying a claim. Adherence to the principle of disclosure in California helps insurance agents build trust with clients, promote consumer protection, and maintain ethical standards in the insurance industry. Question 103. Insurance claims handling. Under California insurance regulations, what is the purpose of the examination under oath during the claims handling process? A. To verify the authenticity of the claim. B. To assess the extent of damages. C. To determine liability for the claim. D. To expedite the claim's settlement. Answer A. To verify the authenticity of the claim. Explanation. In California, the examination under oath is a procedure conducted by the insurer during the claims handling process to verify the authenticity of the claim. It allows the insurer to obtain sworn testimony from the insured or other involved parties regarding the circumstances, facts, and validity of the claim. Assessing the extent of damages, typically done through appraisal or assessment processes. Determining liability for the claim involves evaluating policy coverage and circumstances of the loss. Expediting the claims settlement process aimed at resolving claims efficiently, but not related to examination under oath. Understanding the purpose of examination under oath in California helps insurers maintain integrity in claims handling, prevent fraud, and ensure compliance with regulatory requirements. Question 104. Insurance policy analysis. In California, what is the role of the insuring agreements section in an insurance policy? A. To outline coverage limits. B. To specify policy exclusions. C. To summarize policy terms and conditions. D. To define the scope of coverage. Answer D. To define the scope of coverage. Explanation. In California, the insuring agreements section of an insurance policy plays a crucial role in defining the scope of coverage provided by the insurer. It outlines the specific risks or perils that are covered under the policy, along with the obligations and responsibilities of the insurer in providing coverage to the insured, outlining coverage limits, detailed in separate sections of the policy, including endorsements, specifying policy exclusions, found in the exclusions section to limit coverage, summarizing policy terms and conditions, covered in the policy overview, declarations page, or policy summary. Understanding the insuring agreements section in California insurance policies helps insured parties clarify coverage details and ensure that their insurance needs are adequately met based on the defined scope of coverage. Question 105. State insurance laws and regulations. Under California insurance regulations, what is the purpose of the insurance commissioner? A. To sell insurance policies to consumers. B. To regulate insurance industry practices. C. To investigate insurance fraud cases. D. To provide legal advice to insurers. Answer. B. To regulate insurance industry practices. Explanation. In California, the insurance commissioner is responsible for regulating insurance industry practices to protect consumers and ensure fair and equitable treatment in the insurance marketplace. The commissioner oversees insurance companies, licenses insurance professionals, enforces state insurance laws, and investigates consumer complaints related to insurance practices. Selling insurance policies to consumers, handled by insurance agents and brokers, not the insurance commissioner. Investigating insurance fraud cases, handled by specialized fraud investigation units. Providing legal advice to insurers, managed by legal professionals, not the primary role of the insurance commissioner. Understanding the role of the insurance commissioner in California helps stakeholders navigate insurance regulations, maintain compliance, and promote transparency and fairness in insurance transactions. Question 106. Insurance industry trends and developments. How does climate change impact the property insurance market in California? A. Reduces insurance premiums. B. Increases underwriting guidelines. C. Raises risk of catastrophic losses. D. Lowers policy exclusions. Answer. C. Raises risk of catastrophic losses. Explanation. In California, climate change poses a significant risk to the property insurance market by increasing the frequency and severity of natural disasters such as wildfires, floods, and earthquakes. These events can lead to catastrophic losses for insurers, necessitating adjustments in risk assessment, underwriting practices, and insurance premiums to manage heightened risks associated with climate change impacts. Reducing insurance premiums, typically influenced by multiple factors beyond climate change alone. Increasing underwriting guidelines, reflects adjustments in risk evaluation but not solely due to climate change. Lowering policy exclusions. Exclusions are defined by policy terms, adjusted based on risk assessments and regulatory requirements. Understanding the impact of climate change on the property insurance market in California helps insurers develop strategies to mitigate risks, enhance resilience, and maintain sustainable insurance operations. Question 107. Insurance underwriting. What factors do insurers consider when assessing the risk of insuring commercial properties in California? A. Historical weather patterns. B. Proximity to emergency services. C. Consumer spending habits. D. Local zoning regulations. Answer. B. Proximity to emergency services. Explanation. When assessing the risk of insuring commercial properties in California, insurers consider factors such as the proximity to emergency services like fire departments, police stations, and medical facilities. Access to prompt emergency response can mitigate potential losses and damages, influencing underwriting decisions and premium rates based on the property's risk exposure. Historical weather patterns, considered for assessing natural disaster risks. Consumer spending habits, irrelevant to property insurance underwriting. Local zoning regulations, influence property use and construction but not directly assessed for emergency services proximity. Understanding the factors insurers consider in commercial property underwriting in California helps property owners and insurers align risk management strategies and insurance coverage to protect against potential losses. Question 108. Ethics and professional conduct. In California, what ethical principle guides insurance agents to disclose conflicts of interest to clients? A. Principle of representation. B. Principle of loyalty. C. Principle of indemnity. D. Principle of transparency. Answer: D. Principle of transparency. Explanation: in California, the principle of transparency guides insurance agents to disclose conflicts of interest and provide clear, accurate information to clients about their insurance products and services. This ethical standard emphasizes openness, honesty, and fairness in business practices to build trust and maintain integrity in client-agent relationships. Principle of representation involves accurately representing insurance products and services. Principle of loyalty requires agents to prioritize clients' interests above their own. Principle of indemnity focuses on compensating the insured for covered losses. Adherence to the principle of transparency in California helps insurance agents uphold ethical standards, comply with regulatory requirements, and ensure that clients make informed decisions about their insurance needs based on complete and truthful information. Question 109. Insurance claims handling in California. What role does subrogation play in the insurance claims process? A. It determines coverage limits for claims. B. That investigates the cause of losses. C. It assigns liability to third parties. D. It recovers claim payments from responsible parties. Answer: D. It recovers claim payments from responsible parties. Explanation: in California, subrogation in the insurance claims process refers to the insurer's right to recover claim payments from responsible third parties after compensating the insured for covered losses. It allows insurers to pursue reimbursement for payments made to policyholders when another party is legally liable for the damages or losses incurred. Determining coverage limits for claims handled through policy terms and conditions. Investigating the cause of losses done through claims investigation processes. Assigning liability to third parties, part of liability determination but separate from subrogation. Understanding subrogation in California insurance claims helps insurers manage costs, maintain financial stability, and protect against losses caused by third-party negligence or liability. Question 110. Insurance policy analysis. Under California insurance regulations, what does the conditions section of an insurance policy typically include? A. Policy endorsements and amendments. B. Insuring agreements and coverage limits. C. Policyholders' duties and responsibilities. D. Claims handling procedures. Answer: C. Policyholders' duties and responsibilities. Explanation: in California, the conditions section of an insurance policy typically includes the policyholder's duties and responsibilities, such as reporting losses promptly, cooperating with the insurer's investigation, and mitigating further damages. These conditions outline the obligations that policyholders must fulfill to maintain coverage under the insurance policy. Policy endorsements and amendments. Separate section for modifying coverage terms, insuring agreements and coverage limits. Found in the insuring agreements section. Claims handling procedures, detailed in the claims section of the policy. Understanding the conditions section in California insurance policies helps policyholders fulfill their contractual obligations and ensures compliance with policy terms to avoid coverage disputes or claim denials. Question 111. State insurance laws and regulations. Under California insurance regulations, what is the purpose of consumer protection laws related to insurance? A. To reduce insurance premiums. B. To provide legal advice to insurers. C. To regulate insurance industry practices. D. To safeguard policyholders' rights. Answer: D. To safeguard policyholders' rights. Explanation: in California, consumer protection laws related to insurance aim to safeguard policyholders' rights by regulating insurance industry practices, ensuring fair treatment, and protecting against unfair business practices. These laws promote transparency, accountability, and consumer rights in insurance transactions and interactions with insurers, reducing insurance premiums influenced by market factors and regulatory oversight, providing legal advice to insurers, managed by legal professionals, not consumer protection laws, regulating insurance industry practices, handled by regulatory authorities like the Insurance Commissioner. Understanding consumer protection laws in California helps policyholders assert their rights, file complaints, and seek recourse against unfair or deceptive insurance practices, promoting a fair and equitable insurance marketplace. Question 112. Insurance Policy Analysis. In California, what is the purpose of the declarations page in an insurance policy? A. To summarize policy endorsements. B. To outline policy exclusions. C. To specify insured property and coverage limits. D. To define the scope of insuring agreements. Answer: C. To specify insured property and coverage limits. Explanation: in California, the declarations page in an insurance policy serves the purpose of specifying key details such as the insured property, coverage limits, policyholder information, premium amount, and effective dates. It provides a summary of essential policy details for quick reference and clarification. Summarizing policy endorsements, typically listed separately in the endorsement section. Outlining policy exclusions, detailed in the exclusions section to limit coverage. Defining the scope of insuring agreements, described in the insuring agreements section. Understanding the declarations page in California insurance policies helps policyholders verify coverage details, ensure accuracy of policy information, and communicate effectively with insurers regarding policy terms and conditions. Question 113. Casualty insurance. Coverage and exclusions. Under California insurance regulations, what is typically covered under a commercial general liability (CGL) insurance policy? A. Employee health benefits. B. Property damage caused by negligence. C. Business interruption losses. D. Product recall expenses. Answer: B. Property damage caused by negligence. Explanation: in California, a commercial general liability (CGL) insurance policy typically covers property damage caused by the insured's negligence or actions that result in damage to third-party property. This coverage helps protect businesses from liability claims related to property damage caused by their operations, products, or services. Employee health benefits, covered under separate employee benefit plans, not CGL policies. Business interruption losses, typically excluded from standard CGL policies. Product recall expenses may require specialized insurance coverage, not part of CGL policies. Understanding CGL coverage in California helps businesses assess their insurance needs, manage liability risks, and ensure adequate protection against potential property damage claims. Question 114. Insurance underwriting. What role do underwriting guidelines play in the insurance industry in California? A. Assessing and managing risks. B. Investigating claims. C. Setting premium rates. D. Providing legal advice. Answer: A. Assessing and managing risks. Explanation: in California, underwriting guidelines play a critical role in the insurance industry by guiding insurers in assessing and managing risks associated with potential policyholders or insured risks. These guidelines outline criteria for evaluating factors such as loss history, demographics, geographic location, and other risk indicators to make informed underwriting decisions. Investigating claims, conducted separately during the claims handling process. Setting premium rates, influenced by underwriting assessments but not the primary purpose of guidelines. Providing legal advice, handled by legal professionals, not underwriting guidelines. Understanding underwriting guidelines in California helps insurers maintain consistency in risk evaluation, enhance profitability, and ensure responsible risk selection and pricing in insurance underwriting practices. Question 115. Insurance contracts. Offer and acceptance. Under California insurance regulations, what constitutes consideration in the formation of an insurance contract? A. Premium payment by the insured. B. Policy endorsements by the insurer. C. Claims handling procedures. D. Insuring agreements. Answer: A. Premium payment by the insured. Explanation: in California, a consideration in the formation of an insurance contract refers to the premium payment made by the insured to the insurer. Consideration is an essential element of a contract that signifies the exchange of value between parties, where the insured pays a premium in exchange for the insurer's promise to provide coverage and pay claims as specified in the policy terms. Policy endorsements by the insurer, amendments or modifications to policy terms separate from consideration. Claims handling procedures, outlined in the claims section of the policy. Insuring agreements, define the scope of coverage and obligations under the policy. Understanding consideration in California insurance contracts helps insured parties understand their financial obligations and rights under the insurance policy, ensuring mutual understanding and compliance with contract terms. Question 116. Insurance claims handling. In California, what is the purpose of the reservation of rights letter issued by an insurer during the claims process? A. To deny coverage for the claim. B. To acknowledge receipt of the claim. C. To notify the insured of a claim decision. D. To preserve the insurer's rights. Answer: D. To preserve the insurer's rights. Explanation: in California, a reservation of rights letter issued by an insurer during the claims process serves the purpose of preserving the insurer's rights to deny coverage or limit its obligations under the insurance policy while continuing to investigate or evaluate the claim. It notifies the insured that coverage for the claim may be subject to certain conditions, exclusions, or policy provisions that could affect the insurer's liability. Denying coverage for the claim occurs if coverage is excluded or not applicable under policy terms. Acknowledging receipt of the claim, done initially upon receiving the claim submission. Notifying the insured of a claim decision, done after investigation and evaluation, separate from reservation of rights. Understanding the reservation of rights process in California helps insured parties navigate claim disputes, understand their rights and obligations, and seek appropriate legal advice if coverage issues arise during the claims handling process. Question 117. State insurance laws and regulations. Under California insurance regulations, what is the purpose of the free looker period for insurance policies? A. To allow policyholders to cancel policies without penalty. B. To provide discounts on insurance premiums. C. To extend policy coverage limits. D. To waive deductible payments. Answer A. To allow policyholders to cancel policies without penalty. Explanation: in California, the free looker period for insurance policies allows policyholders a specified period after purchasing a new policy to review its terms, coverage details, and conditions. During this period, policyholders can cancel the policy without penalty and receive a full refund of premiums paid, ensuring that they have adequate time to evaluate their insurance needs and the suitability of the policy. Providing discounts on insurance premiums, determined separately based on policy terms and insurer practices. Extending policy coverage limits. Policy terms define coverage limits not affected by the free look period. Waiving deductible payments. Deductibles are outlined in policy terms, not waived during the free look period. Understanding the free look period in California insurance regulations helps policyholders make informed decisions, review policy terms, and ensure that their insurance coverage meets their expectations and needs before committing to the policy long term. Question 118. Insurance policy analysis. Under California insurance regulations, what is the purpose of exclusions in an insurance policy? A. To specify insured property. B. To limit coverage. C. To define policy endorsements. D. To outline claims procedures. Answer: B. To limit coverage. Explanation: in California, exclusions in an insurance policy serve the purpose of limiting coverage by specifying risks, perils, or situations that are not covered under the policy. These exclusions help insurers manage risks, clarify coverage limitations, and define circumstances where claims may be denied based on policy terms. Specifying insured property, detailed in the declarations or insuring agreements sections. Defining policy endorsements, amendments or modifications to policy terms separate from exclusions. Outlining claims procedures, done in the claims handling section of the policy. Understanding exclusions in California insurance policies helps insured parties identify potential coverage gaps, assess risk exposures, and consider additional coverage options to address specific insurance needs and potential liabilities. Question 119. Casualty insurance. Liability and legal concepts. In Casualty, what legal concept applies when an insured transfers their rights to recover losses to the insurance company after being compensated for a claim? A. Indemnity. B. Subrogation. C. Contribution. D. Negligence. Answer: B. Subrogation. Explanation. In California, subrogation is the legal concept that applies when an insured transfers their right to recover losses to the insurance company after the insurer has compensated the insured for a claim. Subrogation allows insurers to pursue recovery from responsible third parties to offset claim payments made to policyholders, ensuring that the party ultimately responsible for the loss bears the financial responsibility. Indemnity. Principle of compensation for losses incurred, not related to subrogation. Contribution. Sharing of loss among multiple insurers, distinct from subrogation. Negligence. Legal standard for determining liability, not related to subrogation process. Understanding subrogation in California insurance law helps insurers manage claims costs, maintain financial stability, and ensure equitable distribution of loss responsibility among parties involved in insurance claims. Question 120. Insurance underwriting. What role do loss control measures play in insurance underwriting in California? A. Assessing and managing risks. B. Investigating claims. C. Setting premium rates. D. Providing legal advice. Answer A. Assessing and managing risks. Explanation. In California, loss control measures in insurance underwriting refer to proactive strategies and practices aimed at assessing and managing risks associated with potential policyholders or insured risks. These measures include inspections, safety programs, risk assessments, and recommendations for risk mitigation to reduce the frequency and severity of losses. Investigating claims, done separately during the claims handling process. Setting premium rates, influenced by underwriting assessments but not directly related to loss control measures. Providing legal advice, handled by legal professionals, not part of loss control responsibilities. Understanding the role of loss control measures in California insurance underwriting helps insurers evaluate risk exposures accurately, make informed underwriting decisions, and establish effective risk management strategies to protect against potential losses and liabilities.